Good day, everyone. Thursday, March 30. Special day. Not just because Tom Thornton's in the house, but it also is opening day for baseball. I don't know how many of you are baseball fans. I grew up on a baseball field. I'm heartened to see that they've implemented some new rules this year to try to speed up the game. Living in Boston for many years, though, I was reminded baseball is not meant to be played at night in April. The start of the season earlier and earlier. Today's March 30th. I don't know if the Red Sox are at home today or not, but at any rate, opening day for baseball. It's been a couple of weeks since we did a space. As is our custom, I'd like to highlight this date in history. Get through this quickly, but I always learn something. Hopefully you do as well. Just reminds me how little I have read, how much I need to read. So not in any particular order, but just at random. In 1853, the famous post-impressionist painter, Dutch painter Vincent van Gogh was born. 1853. An extraordinary man, extraordinary artist. Here's one for you. 1867. Secretary of State William Seward, under President Andrew Johnson, signed the Alaska Purchase, the treaty ceding Russia and North America to the United States for a price, $7.2 million. $7.2 million. That amounted to 2 cents per acre. Sounds like even a better deal than the island of Manhattan. And then finally, more recently, in 1981, hard to believe this was just 42 years ago, there was an attempted assassination of Ronald Reagan in Washington, D.C., outside the Washington Hilton. Reagan and 3 others were seriously wounded, and he happily recovered. I remember it was Press Secretary Brady. He was really badly injured by this whole thing. We had the Brady bill passed as a result of this whole thing. But at any rate, those are our 3 dates in history. So now to the markets, and it's been quite a start to the year. I certainly didn't get this market right, but we have someone who has a good nose for these things in the house, Mr. Thornton, good friend. Been quite a start. If I look at my Bloomberg, it's his Nasdaq's at 15% so far. One of the best quarters in quite a while. It's market's taken a lot of folks by surprise. There are a lot of stresses and strains. The divergence and volatility between what's going on in the bond market and the equity market. A lot of concerns now about the economy, intensified concerns because of the banking problems that we've had and the tightening of lending standards, which was already in evidence before this occurred. And it looks like, many think this all but assures that we're going to have a recession. No bank is above suspicion. I think it was extraordinary how quickly Silicon Valley Bank went under. No bank is above suspicion, and as John Roque, who's a good mutual friend of both Tommy and myself, and is no stranger to these rooms, he wrote in a very timely way, reminding everyone, it was 3 weeks ago, that it's hard for the market to do well if the financials are doing poorly. Well, that was the case initially, but I don't know. The market seemingly is rejecting that memo. Anyway, so the question is, how long can this divergence go on between, you've seen extraordinary leadership out of large cap tech. I think, the fact that they're long duration assets and you've seen rates plummet, combined with the idea that they have strong balance sheets, has been a point of attraction for many. But let's not forget who their end customers are. And so, the question is, how how far and for how long can this continue. I read somewhere today that I think since the start of the year, earnings estimates, I think it's for the first quarter, have been revised down by 5.9%. So you've got increasing clouds, storm clouds over the economy, falling estimates. The market's not cheap by any measure. Some parts of the market are doing very poorly. There's been very, strong, narrow leadership out of the large cap tech. So there's a lot to talk about. Tommy, really good to see you. Thank you for being generous with your time as always. How have you been?
Hey George, I've been good. Can you hear me okay?
You're great. You're great. You always
Okay.
got a good nose for things and have a great way of putting the pieces together. So why don't you just have at it? We'll get into questions, and I'm sure we'll have some folks come up on stage. And we're starting at 4:15. People have lives, they have families, so I don't know how long we'll go. Hour.
I have a 6 o'clock dinner, so I've got
Okay.
to head out at 6. So
Okay. So why don't we call us at 5:45? That'll give you ample time.
okay.
So why don't we get into it? And Tommy, the floor is yours. Talk about whatever, wherever you want to go with this. I think you and I were talking the other day, and you were mentioning how it's hard to have traction on a lot of things. So many things are trendless. They're up, they're down, and the market's been frustrating, confusing for a lot of folks. So have at it. The floor is yours.
Okay. Well, I think that one thing that I've talked about is that this Q1 um, was really the first quarter I can recall that we didn't have some sort of outside catalyst. We didn't have the China trade war. We didn't have COVID, lockdowns, supply chain problems, um, other stuff that sort of came into the narrative that really, hurt the markets, obviously, and it gave companies a pretty reasonable excuse of why they saw earnings slow down and such. So I think that what we have now is a quarter that, with basically most of the quarter done, we have a new banking crisis that I don't necessarily think it's over, and I think that the lasting effects from this will be tighter lending standards. I think that banks are going to be under a lot of scrutiny. There was one out there today that was being talked about as insolvent, and I'm not going to get into it. I don't do that. Um, it was a smaller bank, but regardless, one thing that happened last year that I look at attribution studies, and specifically with the S&P and the Nasdaq 100. And one thing that happened last year is that the top 10 Nasdaq stocks, the NDX, those top 10 stocks attributed for the majority of the losses, for the 33% loss that we had last year. And the top five specifically were just under 50% of the total losses. And you had Amazon down almost 50%, Apple down 26, Meta down 64, Tesla down 65, Microsoft down 28%, Nvidia down 50%. And so it's interesting. I think a lot of what's occurred this quarter has been the shift in positioning. And the shift, you can now look at it where the top five stocks in the NDX include Apple, Nvidia, Microsoft, Meta, and Tesla. Those by themselves attribute to 63% of the gains. And the top 10 um, by themselves really are 8% of the gain by weights, and that's obvious, and we've seen this happen before. The thing that's different, I think, is that the valuations for these companies that have moved up are starting to move towards historical high ranges, and a couple of them. I mean, you can look at um, Apple, for example. It's not cheap. Nvidia is really really expensive for them right now. So I think that we have this positioning move. It's been a really, strong move. I will say that I had a great year last year. This year, I'm treading water. I'm up on the year, but not by much. Um, I have taken a cautious approach, most recently with technology, and I've been short some technology. Last year I covered a lot of technology, made some good gains on the long side and short side, but I covered some towards the end of the year. I didn't get the great signals that I had hoped that I would for these to get in there and buy. And quite frankly, I'm not the type. It's just not my character to chase gains at this. That's just not in my nature. I don't chase things. But I think overall the risk reward here is unfavorable, especially with the financials that continue to be very messy. On the 14th of April, we get the first of the big banks reporting. That should be rather interesting on those conference calls. It'll be interesting to see what the spillover is for the big banks because I remember one time that Bill Gross, before the great financial crisis and when the subprime lenders were starting to fail, he said, that whales need plankton to survive. And plankton are those little fish that, clear off the algae and crap off the whales. And if there's no plankton, the whales will die. So I'm not saying the whales, the big banks, are going to die, but we are seeing some plankton pass away. And I think that's something that we're going to have to watch. I think it's you really want to see strong banks in a market to basically because they it's the liquidity, it's the funding. I think that's really, really important. And if the banks are under stress, they will tighten up lending standards, which they already have. And I think that's going to be something that the lag effects of the Fed, it'll start to become very evident this year. It's not, it's there, but it's not debilitating. Again, I talked about the narrow leadership in the NDX, and I think that's unsustainable. I honestly, I would love to have gone back and said, sure, I'm in long Nvidia and I'm up 85%. That would be great. Meta, I actually did. I was long for a little bit off the lows, but I didn't stick with it, and it's up 71%. Tesla, I'm still short the stock. I have a gain in it. My cost basis is a lot higher, but I did take off the majority of my Tesla lower, and that was fortuitous. Just going back to one thing, now that we have basically a clean quarter, and I will say the banking crisis, that's one thing, but we don't have those really significant things that we had previously that would hurt demand. So the demand picture this quarter is going to be front and center on my mind to see how things play out. And the two stocks that I'm really focused on are Apple, because Tim Cook last quarter said, and he got the stock running on this, said we would have had a much better quarter if China wasn't locked down. So China's not locked down anymore. So I'm hoping for Tim's sake that they have a much better quarter. I have a feeling that it's going to be tough to see them really move the needle on an iPhone that looks like the three previous versions of the iPhone at a higher price point. So I think that's going to be tough. As far as Tesla, that's the other one I'm focused on. The estimates for their deliveries are coming out this Sunday, probably around noon Eastern time. And the consensus is 420, no pun intended. That's the number. I've talked to some of the Tesla bulls. Dan Ives sent me his note, and he's at 420. There's possibility that we could see a little higher than that, and that's one thing. But we have to look at it as far as the Tesla bulls will say, oh, it's a record quarter. Great, it's a record quarter, but last quarter they ratcheted down their estimates for deliveries down, some from nearly 500 cars down to 400, and it came out at 405. And that was, and Tesla's up 58% since. So there you go. But they've cut prices to move metal, and that has an effect on earnings and margins that I think are going to be rather um, stunning for some of the Tesla bulls. I think that will hit earnings throughout the entire year. Gordon Johnson, if he's around, he put out a note talking about what he thinks the profit per car. Let's say it's $9,000 this year could be half that. So I think that's something that's going to be difficult. I think it's going to be an even more difficult quarter going forward because they don't have any new cars coming out. Their cars are a bit stale. Um, I think demand was pulled forward. So I think that's a risk right there. And, the backdrop of all this is that the Fed is going to pivot. And we've had this narrative that the Fed's going to pivot because inflation is coming down, or actually, the Fed started, this whole new Fed pivot and rate cuts coming this summer was due to the uncertainty and collapse of Silicon Valley Bank and Signature and the turmoil and the backstop of all the banks. But I think that's if the banks can stabilize, and I think that for the most part they have. I know that's like a loaded thought because it could get a little bit dicey again. But if that is not in play, I think then we have the issue that people are going to start looking, and the Fed are going to start looking at inflation data again. And I think inflation data will start to come down and moderate, but I don't think I think the risk is that it doesn't come down fast enough, and I think course remains really sticky. And I had a long conversation with Julian Brigden, who I think is one of the best when it comes to macro and what the Fed is doing and inflation. And he reiterated to me that he thinks core is going to stay elevated throughout the entire year, and that the Fed won't cut rates. He didn't really speculate that they're going to continue to raise rates, um, but he said they will pause if anything. And I think that is overly hopeful thinking for a lot of the tech companies and people that are buying tech that think that, oh, well, if interest rates are going lower, it's going to be game on for tech. I think tech is a cyclical industry, and a lot of people are looking over the valley called a recession at what better times could come out of it. So you'll hear better things here and there with tech, and I think that the onus is on those companies to increase, show that the demand is still there and that they can beat numbers. I don't think numbers. I think Michael Cantro, if he's around, he would reiterate as well that um, numbers remain too high for earnings, and so I think that's something that will be really, really important this Q1 earnings. But that being said, I am long some stuff. I'm not a one-sided bear all the time. I was looking at all my trade ideas, and I'm almost 50. I've been almost 50-50 longs and shorts with closed ideas over the years. And I do like the way energy's setting up. I think that energy there's a long trade there. It's not necessarily going to be as easy as when inflation was ripping higher and every commodity was going higher. But I do think that there's value there. I have about a 10% long position in the sector, the various stocks and ETFs. I think materials also have some upside potential, and I think that banks will set up perhaps after earnings for a long trade, but I don't want to touch banks. I tried briefly with some large banks, and I exited those pretty quickly. I don't want to take a lot of chances right now in the market, and I don't think people need to necessarily think that, oh, we're going to go to all-time highs. The work that I look at with DeMark indicators haven't been as clear as as I previously have seen. Within the NASDAQ 100, we are starting to see more DeMark exhaustion sell countdowns. Taking sometimes I'll do I'll set up a more strict version of the DeMark sequential, and the NDX with that is on day 11 of 13. So after you get a 13, the rule of thumb is you should see a price reversal or at least some sort of stalling within 5 to 10 days. And so I think that's something that's possible in that sector. Uh, we don't see a lot of shorts in the market as much as it sounds like shorts are always talked about, but the data doesn't really reflect that. For example, um, NVIDIA is and NVIDIA and AMD are two I'm short, and I recently shorted those, so it's not like I'm down 86% in NVIDIA. I think I'm down maybe 2%, and I'm slightly profitable in AMD. But NVIDIA has a days to cover. It's less than 1 day. It's remained low. There's been tons of call buying. And AMD, let me just run it here. AMD has 0.43 days to cover. And there's also been tons of call buying. Now, call buyers can be right for a brief moment. But what happens, and what I've seen, especially in the last few years, is that you actually want to fade heavy call buying. And you also want to fade heavy put buying. And it works the same way. I think that with the proliferation of short-term options, I think that it's actually been a better indicator versus short interest as far as short-term positioning with traders. So I'm looking at that as a risk where you have too many people buying calls within that narrow handful of tech names that have moved up already, and I think that that's something important. For example, I just want to say that at the end of December, there was heavy put buying in AMD at the lows, and I'll run back to NVIDIA, and there was heavy put buying in in NVIDIA, and I can post it on Twitter, but there was heavy put buying, which I think started the squeeze higher. And I think that that is really important that now we've shifted to the other side of it. And, that's generally what I'm seeing, George. I mean, among other things, but that's my current positioning. I do, again, I have longs and I'm long several, ideas. Again, I really do like the way energy's setting up here. But I think that this is not the market you want to be chasing tech. And as always, if I'm wrong, I'll jump on my sword and uh, eat it, take losses if I have to, and manage my risk. But that's generally how I'm seeing the whole world right now.
That's absolutely terrific, Tommy. Thank you so much for that. What a tour de force. You cover so many things so effortlessly in a relatively short period of time. One just general observation or question I have for you, and that is, regardless of your views, we've known each other for a few years. It sounds like, and you touched on this, you don't really want to swing the bat terribly hard right now. It's not an environment for huge bets. So in other words, your conviction level, whatever it is, relative to opinions I've heard you express in the past, it is not as high. You don't want to dig in a super strong way now. Is that fair?
Yeah, that's exactly it. And I'm agnostic many times when it comes to being either long or short, and um, I desperately want to find longs, and because I have more of my clients and subscribers want to see long ideas, and again, I don't chase some of the nonsense of the tech names that run up. There's times where I am long them, but at this point I'm not taking big swings right now. I'm trying to look at some value oriented long ideas. I thought that the energy names looked good. I started buying them the middle, yeah, the middle of March. I started buying materials and energy, and they've done okay. but no, it's not a time where you want to take, massive swings. And one thing I always recommend and state is I don't, sorry, I'm choking here. I don't take big, weighted positions. My largest weighting is 5%, and um, that is so I can allow myself some wiggle room, and I'm not stopped out. And I'm honestly, I'm actually very human in the sense that I have anxiety um, when I am too big in something, and I don't want to be in that frame of mind. I can be short something 5%. If it goes against me 10%, it's not going to change my life dramatically. And that's generally what I try to stress to people. You can make money and you can do really well when you stay diversified, keep your sizing proper and not out of whack. I mean, I'll tell you, I think that's something that you and I, George, have talked about. And sometimes you don't want to swing for the fences, um, and you want to just allow the process to work. And if you have a position that um, you have a 2% size position in, and it's working, a lot of those can add up. So I really am about risk management when I'm managing a portfolio. I could do better, obviously, if I weighted myself larger, but um, it, again, it fits my personality.
Makes a lot of sense. Hey, question, Tommy. What do you any take on interest rates of the bond market right here?
Well, that's been trading like, meme stocks, the 2 year. Look, it closed at four, almost 412, and it's bounced off the lows, which it almost hit 3.5%, and now we're at 411. Look, I think that it does have the potential to move higher. I think the again, I think that the big volatile down move in rates was clearly something that legacy shorts in the bond market got taken out and crushed. So I think that exacerbated the moves. So it's possible that I could see rates drift higher again. And we have some inflation data coming up. We have earnings coming up, and I think that to me it looks like rates could move higher. One thing also, if we start to see a bull steepening in on the curves, I think that will lead us towards a recession. And I do believe we will see a recession. I don't want to like say when, but it's quite possible that we will have a recession this year. I know that's not very edgy or anything enlightening, but I think that again, I think tech investors are looking over the valley of the recession and putting a lot of hope that the Fed's going to come in and cut rates. And even if they do cut rates, as we've seen in the past, cutting rates doesn't necessarily mean that it's the all clear, because we've seen markets when bad news becomes bad news, that that weighs on that on the equity market and companies' earnings. So that's kind of how I see right now with rates.
That's terrific. Okay, let's move along here. Let's bring some of the community into the conversation. Let's start off with Not Chase Coleman. Hey, Not Chase Coleman, how you doing?
Josh,
Uh,
hold on a
and
second. I just want to say, Josh and I, we share a lot of ideas, and we don't necessarily agree all the time with ideas, but I do have a lot of respect for Josh. He's a younger fund manager and has absolutely nailed it on many ideas. He was long. His largest position was Meta off the lows, and absolutely crushed it. He was long Nvidia, and I think he'll tell us about that. But he's also been pretty adamant about the crypto space. I'm not a crypto person, and I'm listening to what he has to say. It may not be regarding the price of Bitcoin, but I think it's the point that we talked about earlier, and I wanted him to come on. was some of the news with Binance. So Josh, give it a go,
And,
and everybody should follow him.
and Josh, thank you for showing up. Tommy told me about you, so I'm really keen that you're here. Take it away. The floor is yours.
Absolutely. Thanks, George and Tom. Great to hear from you, man. Yeah, I'll have a quick tidbit on Nvidia. Have been sort of a long-term Nvidia bull, and obviously that's been quite rewarding. But at a certain point, I think price is price, and right now the price is wrong. I'm not saying that there's any kind of severe fundamental deterioration, but generally, when it's reached, insane levels like it did late 2021, the reversals are not 5 or 10%, they're 40, 50%, right? So it's at its most egregious valuation in its history. Um, and I'm not saying that the AI craze is unwarranted. I think that AI is real. I just think that we've probably pulled forward a significant amount of the returns for a stock like NVIDIA. So the asymmetric risk or reward here is to the downside, unquestionably. But I'll spend a little bit more time on Binance and Coinbase and just the broader crypto space because I think it's important. And obviously, there's been a lot of news coming out this week, particularly from Binance and Coinbase. And I think it has some very severe or potentially severe ramifications for the entire space that is largely propped up by wash trading on Binance. So, just to kind of give everyone some background on the situation. So, earlier this week, Binance was issued a CFTC complaint. Obviously, the CFTC is a civil regulatory agency, so there is no criminal enforcement action as of yet. But reading through the CFTC report, um, it is incredibly, incredibly revealing and some really scathing information. So it's very clear that Binance launders money for the worst human beings and entities on Earth. So one being Hamas, so that's nice, and other terrorist organizations, sex traffickers, drug dealers, and they got access to CZ's. CZ is the founder and CEO of Binance. If you haven't heard of him, they have access to his signal messages, and there's um, uh, a clear intent to find ways to avert any kind of regulation or any sort of rules that are in place. But I think that that letter or that complaint by the CFTC is really a warning to CZ that you're going to get arrested. And this isn't a US, I mean, this isn't just a US problem. This is a multinational problem. And I believe it'll be a multinational take down of CZ. If FTX was Bear Stearns, Binance is Lehman. Arguably, and I can go into the data for you in a second, but it's arguably a larger equivalent to Lehman just because of the sheer uh, a monopolized market share that it holds over trading volume and liquidity. Um, but yeah, I think it was a warning that CZ is eventually going to get arrested. I think it is inevitable. So just to kind of get into it a little bit more, if anyone doesn't know what wash trading is, just think of it as fake a liquidity. So essentially, it's a small. It involves a small group of whales, if you will, who control highly levered positions and trading activity on a specific venue. What is that venue? That venue is Binance. Okay. And by the way, I know that people might be confused about Binance.us and Binance. I'm talking about Binance, the main platform. And another thing, if you read the CFTC complaint, CZ has it's not illegal to use a VPN, but it is illegal to encourage users to circumvent the law in order to gain access to the platform. So that's just another thing. But anyway, regarding wash trading, so essentially there are a small group of traders or institutions who control all of the trading volume and create the illusion of a liquidity when it's really just a small group of entities that are controlling the flows, right? So let's just break the numbers down. Okay. So when FTX went bust in October of last year, Binance had 48% of spot trading volume of crypto and 58% of derivatives volume. Now, what's interesting is that derivatives actually control the vast a majority of the trading volume. And derivatives are not allowed in the United States for crypto, right? So, in order to trade derivatives, you likely have to choose an offshore venue. And Binance is that primary offshore venue. So, in the event of what I believe will eventually be a takedown of CZ and Binance, that would lead to likely a run on Binance. And if there is a run on Binance, essentially your primary counterparty goes defunct and liquidity evaporates, leading to widespread contagion across the entire industry and a massive liquidity crisis across cryptocurrencies. So, as of February, uh, if you look at the current market share that Binance holds, they now have 61 or actually 62% of spot trading volumes and 63% of derivatives volumes. So essentially, without Binance, there is no crypto market. And put out, does everyone hear me?
Go on.
Yeah, go
Go on.
ahead. And by the way,
Yep.
this is really, really interesting. Just I want to caution you though. I don't want the crypto is one of those polarizing topics. So
Absolutely, yeah.
if we could kind of get to, I mean, I could listen to this all day. I love what you're saying, but I don't want the room to be hijacked in a crypto discussion. So maybe turn to like how are we supposed to make money out of this, whether it's Coinbase or
Absolutely.
whatever.
All
Well,
right.
Yep.
one
So
thing, George, I don't say this. Josh, I don't think is necessarily saying that he's anti-crypto. I think he's just
No,
concerned about the liquidity
yeah.
and
No, Tommy, I understand that. I mean, imply
yeah,
otherwise. I'm just saying crypto tends to be a sort of sideshow for a lot of folks. Want to talk about the
yeah.
markets and stuff. That's all. But Josh, this is fascinating. Keep going, but try to bring it to sort of an investment. That'd be great.
I will, and I'm actually about to get to
Good,
the point.
good,
Don't
good.
worry. All right. So I've heard a lot of people say that the collapse of Binance is good for Coinbase, right? I've heard that. Okay, so I am short Coinbase, just full disclosure. Here's why it's not good for Coinbase, right? So Coinbase is a US based exchange, a US based regulated exchange. And in the United States, you are not allowed to trade derivatives. Okay. So if Binance is gone, Coinbase can't pick up the slack. So they cannot fill the hole of a liquidity. Okay. So that's a huge problem. Okay. And aside from the contagion effect that will occur if Binance were to collapse, Coinbase has a lot of structural issues. So it's very clear that other than Bitcoin and Ethereum, every other, altcoin, shitcoin, whatever you want to call it, on Coinbase is an unregistered security. Okay. And all of the juice in Coinbase's fees come from the take rates on the non BTC Ethereum coins and tokens. So once all of those are delisted, during an environment where there is compressed fees and volume, this is only going to make their operating model more ugly or uglier. So I don't see the fundamental short to medium term bull case for Coinbase. I've heard a lot of crypto bros and uber bullish Bitcoin people saying that they're going to benefit, and I'm like, maybe somewhere way down the line they do, but you cannot ignore the structural issues that are in their way. And I thought it was hilarious because recently they decided to launch or proceed in the process of launching a over or offshore venue for trading. And I think that's completely tone deaf because one, it's still pretty fresh after the FTX collapse. Number one. And number two, you know, crypto can't really go mainstream without US legislation. So for them to play regulatory arbitrage, I think is incredibly poor taste on their part. It shows some level of hubris that we don't really care about, the country that we're actually domiciled in, which is the United States. So I just think it's just poor form all around. But I hope that that gives people some color on the massive contagion risks and the structural problems that Coinbase has.
That's
And if anyone wants to speak more offline, I'm happy
that's
to.
absolutely terrific. By the way, do you think this is a 2023 event?
Yes.
Got it. Okay, that's good to know. I'm sure there'll be plenty of questions. That was fantastic. Don't go anywhere. Don't
Thank
go
you, Jordan.
anywhere. I'm sure there'll be some follow-up questions. I'd like to move along. Let's go to Bag Holder. He's been waiting for a while. Welcome, Bag Holder. The floor is yours. Bag Holder, are you there? Okay. Let's go to Mark Newman, please. Mark, can you hear me? Thomas Thornton, are you able to hear me?
I can hear you. I
Uh,
don't know what is going on here.
okay,
Yep, got you loud and clear.
got it. All right.
I can hear you.
Okay.
I can hear
Is
you,
bag
Jordan.
holder there?
Bag Holder, you there? Guess not. Newman, Mark Newman, I think you said you couldn't hear. Maybe you should leave and come back in. All right, let's keep moving here. Let's go to AJ. AJ, the floor is yours. Can you hear me, AJ?
Hey, I can hear you. Hey,
Go
good
for it.
afternoon. Thank you for having me. So echoing some of what Tommy said, right? So energy as well. One company that I started slowly building a position in is VET, Vermilion Energy. It's a company that has a FCFE 40% yield moving forward, and they've also paid down 1 billion of debt since COVID, and they continue to return cash to shareholders. So it's something that I've been watching for a while. 10% dividend and is trading at an 18% discount right now. So I slowly started adding in, and I think the fears and energy really started maybe 2 weeks ago when they started to get compressed due to a stronger dollar, risk aversion. There was some West African crude issues going on, yada yada yada. But I started slowly scaling into that company as well as another energy company called SU. So kind of mimicking, very similar to what Thomas said over here on the right side of our panel. The other side also, I know we mentioned banks, not longing banks. That's a great point. But the one bank that I am slowly building a position in is Schwab. Plan to hold that long term. I know it's going to struggle for the next 6 months to a year, so I'm not scaling in very large at this time, but I'm slowly positioning myself there. The other side of trades that I'm playing is TLT. Obviously, it's very impacted by interest rates and the expectations since they've been compressing. Whether or not they're right or wrong, we will find out. But it has obviously been helping TLT up. So I've slowly been adding since the 102, 103 area, and we'll keep watching that for some time. Another thing I like to play, as I do very closely, is in the bond market. Is a company. Well, it's not bond. It's called JAA, so it's for triple A's for bonds. Pays a monthly dividend, annualizes about 4 to 5%, depending on the LIBOR rate. So obviously that fluctuates, and right now it's kind of like a hold. Money markets had another $68 billion go in this week, so I think that added pressure will continue on that side of the market as long as this bank story, quote unquote, keeps going. So those are where I'm playing it. Short term,
Appreciate it.
I day trade and invest, but yeah, that's kind of what I'm doing for medium to long term
Thanks
investing.
very much, AJ.
Thank you.
Appreciate the comments. Okay, let's go to Mr. Newman. Are you there? Can you hear me? I don't know what is going on here. Huh. All right. Let's go to Robert. Robert, floor is yours.
Hey guys, good afternoon. Tommy, how are you, sir?
Mr. Bendock, how are you? This
I'm
was
doing
one
I'm
of my
doing great.
derivative traders extraordinaire back when I had my fund. So nice to hear you, Bob.
Thanks, Tommy. So just commenting on what Tom said earlier about Nvidia and some very high call volume today, in particular, on the options that expire tomorrow between the 265 strike and the 280 strike, there was probably about 177, 87, 92, about 135,000 or 140,000 options that traded. Go out 1 month to the April expiration, and there's essentially no open interest or no volume whatsoever, and that in and of itself is interesting. Maybe people are playing for a squeeze in it tomorrow. Who knows? But the other thing to consider is when you have a massive move in a stock like we've seen at Nvidia, one of the things that people do is called substitute position, right? So you're long Nvidia from 190, it's at 260 now. You think you have more room, but that's a lot of meat to leave on the bone. Sell out of your common stock and replace it with a slightly out of the money option, which will give you some more upside, but clearly limited downside. You ring your register, you keep a little bit on the table, and you keep your long bias. That was the point on that. The other thing that I found interesting too is when we looked at the 2 year, when Tommy was talking about the 2 year, there was a massive short squeeze, and Tommy, sure he's well aware of this, but there was a fund, a very large hedge fund, they got caught off sides, and you never see volatility in fixed income the way, not even in third world country bonds, which you see this volatility. But somebody got caught on the wrong side. It ran the 2 yield up dramatically, and there were also a few of the funds in the business that had leveraged positions that also got a little bit hurt. So those are the two things that I picked up on. I'm not a crypto guy, so I really can't comment, but I did find it highly informational and I did learn. So thank you for that insight.
Hey, Robert, let me ask you something. You were touching on Nvidia and tying that comment together with what Tommy was talking earlier about how large cap tech is kind of stretched and so on and so forth. Do you share that sort of bigger view, be a little bit cautious about large cap tech?
Um, as much as I don't have the prowess that Tommy has on the minutia and the micro aspect of an individual company, I just look at it this way. This has been a rocket ride. This has been a vol kind of dampening experience from the risk side. But you're seeing people chase calls, and that to me is always the top, always the top. I
And
would if I had an opportunity to express my view in it, it would not be through a long call position. I would, if I substituted, yes. If I switched out of stock, great. I would have a long call. But if I had to speculate on one position going for the next couple of weeks or months, I would definitely consider owning puts rather for my personal bias rather than anything else.
Let's
hey,
go.
Bob.
Yeah, let's
Well,
go.
just a sec. So, Bob, you're one of the most seasoned derivative traders I know, and
Thank you.
I just would love to get your thoughts on the short-term options and how that's skewed the market for the monthly strikes and your thoughts as far as risk. I'm talking again to a person and asking a question to a person that he has seen more derivative flow than anybody else on this spaces. So, and he's the most humble, generous person I know. And so, your thoughts always very calm and collected, and I value everything you say.
Well, listen, I thank you very much for that. I'm I'm humbled and appreciative of what you just said. Well, with respect to the 0 day options, um, let's face it, they're lottery tickets, right? And the thing that you have to understand is the risk parameter of a 1 day option is identical to that of an expiring option on a monthly, a quarterly, or whatever the case is on the same date. So you have the risk as the owner of the option of clearly just losing all your premium. I think it adds to higher volatility in the individual names, maybe a tad into index world, but that's not as reflected as it should be. I would say this: the best trade I've ever seen in the last, I'm going to say, maybe 5 years, maybe even 10 years. About 2 weeks ago, when the Fed was chipping on the on the when the Fed was on TV, the most amazing thing is as soon as Powell changed his tone, there was a put on the Spider that was a same day expiration. It traded 10 cents, 10 cents, and it expired at $3.69 in 55 minutes. Now, those are the lotto tickets I like to play, right? Those are the things, if you want to take a risk, put something in there like that and let that be, I hate to say your piss money. Listen, you want to take a shot in the market, buy something for a dime on these. I don't suggest chasing them. I don't suggest following them with
Right.
with like a war stick. But hey, you want to take a shot? Something's offered at a dime, buy it.
Got it. That's
And
great, Bob. That's great. Want to work some other folks in the conversation.
yeah, yes, sir. Thank you for the time, George.
No, stay up there. I'm sure there'll be some follow-up questions. Josh, I want to
Okay.
ask you. You were making a comment about Nvidia being stretched. Do you think?
Yeah.
More generally speaking, large cap tech is pretty stretched?
Yes, it is stretched, generally, but I think the issue with, I think it frustrates a lot of people on why there just hasn't been a meaningful correction in a lot of these names is because truly they're just in every IRA, they're in every ETF, they're in every mutual fund. There's always a bid. And I think when, PMs and asset managers don't really know what to do and don't really know, the certainty of the outlook, they just kind of flock to what is quote unquote safe or thought to be as safe. I mean, all those names. I'm excluding Nvidia and Tesla in the mega caps, but the magma names, they have a lot of cash. They have a lot of free cash flow. They almost trade as bonds, in my opinion, right? They're almost like the bond equivalents of the equity market. So there's always a bid there, and that's why they're just rewarded higher multiples. But they are all stretched, and I think Tom posted something about this, and I retweeted it. But he showed that basically the top 5 names in Nasdaq contributed, or was it the top 5 or the top 10, Tom? Yeah, I mean, it was the top 5 names attributed to 50% of the total gains in the NDX year to date,
It's
which
actually
is not
it's actually
healthy.
63%, and the top 10 is 80%, and that's
Wow. Yeah.
that's by design because of the weightings of and the market caps of these
Yeah.
companies, obviously.
Right. Right. But that's not, yeah, I mean, that's not healthy to have that concentration and performance in the market in the long run, So I am worrisome. I do believe that Nvidia does have, I mean, like I said, I think it has the best risk reward to the downside after being a bull for, a long, long while and, being in and out of it on the long side. I've actually never short the stock or been long puts, but I am long puts for a September. So I do expect some reversion to some sort of mean over the next 6 months or so.
That's
Yeah.
helpful. Thank you. All right, we're going to try Newman one more time. Mark, are you there? Can you hear us? Jesus, Mark, I don't know what your problem is. This is just not your day. Um, Maybe I know you've got internet. Maybe turn your phone off and then turn it back on. We're trying, man. All right, let's keep moving here. Let's go to my good friend Bobby J, Mr. J, who knows more about credit than pretty much anybody in these spaces. Good to see you, Bobby. What's going on, man?
Hey, how are
We're
you?
good. What's going on?
All good. So, as you know, when we were on Spaces over a year ago, and everybody was fixated with the HYG as a proxy for high yield spreads, and you suggested I keep an eye on credit spreads and sound the alarm. My thesis was that this is going to be a duration bubble first and a credit issue second, because over the last 30 years, the modified duration of sovereign bonds has doubled, which means that the price sensitivity to changes in yields it was higher than ever because the world was flooded with zero coupon bonds when we were at the zero bound. Now, I never really thought that we'd get to this level of short-term interest rates. You did. You said the economy was going to be hard to slow down, and inflation was going to be hard to slow down. So I didn't really appreciate, to the extent it did until about 3 months ago, that this is going to be a threat to deposits. And George, you're probably one of the few people in the room who remember Reg Q. And when we had Reg Q, deposit rates had a ceiling on them. And when they removed Reg Q, deposit rates went up considerably. And people like Fidelity and money markets took over. The zero bound rates was like simulating Reg Q again. And another thesis that I have as a permanent thesis is that we have excess capacity in the banking system. We're still trying to right size this post deregulation of banks, where we've gone from 18,000 banks down to 4,000 banks, but we still have too many banks to, there's not enough loan and credit demand out there to feed the beast. So as a result, banks ended up doing more treasuries and increasing their securities portfolio and mortgage-backed portfolios from 15% of total assets to 25% of total assets, and loans have in the bank portfolios have declined by about 5 or 6% over the last decade. So I think we have to constantly, because of this excess capacity in banks continue to create problems. They have this weird codependent relationship. It's like two parents. They have the Treasury as one parent. They have the Fed as another parent, and this kid, the banking system, keeps getting in trouble and ignoring curfews. So I'm a bit concerned that I think we're going to get one last big bond rally over the next year or so. I know Michael Howell has said that. I've been going into the front end of the curve a bit early, but we had break evens that were sufficient enough to cover your back if you were wrong. In other words, when you buy 2-year notes at 5%, when you buy 2-year notes at 4%, you have room for 2-year notes to go to 4.5%, 5.5%, or 6% and not lose any money. So we're going to see that continue. So I think this is the last great bond rally that we're going to have, and then we're going to enter a new era of a higher interest rate regime that is going to take years to undo. Because bear in mind, when rates went up and cracked above, I think 4% on 5-year rates in 1969 or 70, whatever year that was, it took about 30 years for them to get back down. So because of debt levels, I think we'll be seeing that. And we need to fix this banking system because it's getting more lopsided, and there's going to be debates about community banks. But I think we've had a lack of consolidation because zero interest rates pushed up the valuations on the smaller banks that kept them from being attractive as takeover because you can't buy a smaller bank because it's not accretive, and also the bigger banks are going to be prohibited about doing acquisitions. But I also think that we're going to possibly see one of the top 5 or 6 banks kind of break up. I think the market will reward eventually a bigger bank for breaking up and, for example, taking a consumer business out and spinning that off, and maybe making the commercial banking side of it, or the investment banking side of it, or the custodial side of it, separate banks. And but we're definitely going to see a a restructuring by the market, and maybe with a boost from regulators over the next balance of this decade of the banking
Yeah,
system. So that's it in a
yeah,
nutshell
yeah,
for me.
Bobby, two questions, please. One, even if we don't have Armageddon, is the outlook for bank profitability pretty downbeat going forward as you see deposits leaving and their cost of funds going up and so on and so forth? I mean, so even if the world doesn't come to an end, I mean, the banks act like they act like garbage, and so even
Yeah,
if even
yeah,
if you don't believe in commercial real estate going to zero, isn't the outlook for banks still pretty challenged?
yeah, it is. But bear in mind, we can part of this will get fixed, and you'll get a rally in bank stocks with one big bond rally.
Right.
Right. So if the 5-year note, heads back down south of 3%, that will not stop everybody from jumping back into banks. So you have to be pretty flexible in order to get this right. And I'd like to hear anybody else's thoughts on that. But it's hard for me to imagine that if monetary policy does finally sink its teeth into the economy, that we wouldn't get a bond rally. And it's hard for me to imagine that with a mid or front end curve rally, that we would not get a bank stock rally.
Right.
But absolutely correct. I don't see any reason why that deposit outflows shouldn't continue, especially when we go back and see that we're going to have a new interest rate regime with higher rates.
Right. And so, I mean, are banks investable right now, one way or the other, or are they just probably, or is it too opaque, or are they problematic?
Well, I have long short positions in banks, um, and um, I think part of them are investable, like maybe the custody banks are investable, but the valuations are not good.
Mm-hmm.
They're just not good, and I never look at price to book, because people were buying Credit Suisse and Citigroup on price to book. That's the ultimate value trap. But I think you got to be really nimble, and I don't think being nimble is consistent with investable.
Got it. Makes sense. Please stay on stage. I know this is going to be a topic of further discussion and interest. Michael, good to see you. The floor is yours. What's up,
A couple of
Michael? Yep. Michael, you
things
got
that
terrible connection. Can you?
analysts. Hello?
Yeah, go ahead. You're in the
Hello?
matrix, but go ahead. Go
Yes.
ahead.
First, it was interesting on the Street Insider, they classified the NVIDIA move as next generation AI deployment and a rotation into tech stocks as safe haven plays. Um, I have a question for Tommy. With the US dollar, I mean, it's taken quite a pounding. It seems like now the dominant theme in FinTwit is the end of the US dollar hegemony and the de dollarization. So I'm wondering what your thoughts are from the technicals on that. And I had one other question. I don't know what I did to offend you. I am a perma bear, but if you could unblock me, because I have to shift to another alias just to see your work, and I'm a huge fan of your work.
Okay, I don't know what
There you have it.
I'm not sure. I unblocked you, but I'm not sure. I was drinking water just now. I almost choked. I'm not sure why I blocked you. Pardon it.
Please don't block
Okay.
me because I love your
Okay.
work.
Well, good. We're all good now. Sometimes it's um, the dollar just keeps drifting in this lower, and I'm kind of in a little bit of a concern about the dollar. First of all, it's still the. I mean, let's just go off of DXY. It's still above the lows that we saw back in the beginning of February, February 2nd, and I think that it could challenge that. And I so on my daily chart, if we hold those lows and have some sort of reversal, and I'm not sure we will, then I think we could see a rebound towards 108. That's just sort of the bullish case. The bearish case on the dollar is that the weekly that I'm looking at for the DXY has a DeMark countdown in progress, sequential countdown in progress, and that's only on week 6 of 13. If that breaks, I have a price objective of around 95 on the DXY, and I think there's the risk and reward for a lower dollar. And if you remember way back, we had a couple Fed chairmen that were just fine with the dollar falling apart because it helped U.S. multinational companies with their earnings. I, I I think that just one side note: if any company says that they had dollar uh, problems with the dollar exchange rate this quarter, I just my head will explode because they blame the dollar going up continuously, and now it's near lows, and it will be near the low for the whole quarter. So you've had this, one thing that is a positive potential for earnings is that you've had a dollar weakness. So that could be a potential little bit of a tailwind for companies. If they still fuck it up and, you know, blame the dollar, then, you basically should short the stock. So that's kind of my thought on the dollar right now. It's got to hold those levels. If it doesn't, then I think we have some,
All right.
we have some further downside. That's it, technically.
Thanks, Tommy. Appreciate that. Let's keep moving here because we got a lot of people who want to ask questions, and I want to get everyone in. Robert, are you there? We tried you earlier. Can you hear us, Robert? I don't know what's happened to Robert.
Yes,
All
I
right.
can. Yeah,
If
I
you have a
can.
quick question, Robert, go for it. The floor is yours.
No, I was just in the queue. I was just in
We
the
chatted
queue.
with
I
them.
I spoke
We
with you,
chatted
Mr.
with
Oh,
Paul. George, is Mark Newman around?
Yeah, I'm
There
here.
you are. Okay,
I'm
let's
now I'm
go.
now sitting camped out on top of my Wi-Fi router because I had just major issues.
Okay.
I wanted to just throw. I'm reconnecting. So can you hear me?
Yes, I can hear
Okay,
you.
great. Well, someone mentioned about the banks earlier, just before, and we had it saying in Japan, when you merge a big bank with a bad bank, you just get a big bad bank. And if you look at 8301 JP on Bloomberg, I don't know how you find it on other systems, but 8301 space JP, that's the Bank of Japan. And if you look at this stock, it doesn't trade a lot. It's really just a marker, to be honest. But like 10 shares, 100 shares a day. But if you look at that since 1989, it has been one way straight down. And I had the pleasure of speaking to Jim Bianco about a month or so ago in Miami. And he made an interesting point about the U.S. banks and how they've been since actually the GFC in terms of a performance. And it's the same kind of deterioration. And excuse me, if we think about Citigroup, it's not 46 bucks. It's $4.60, right? So I think that we are undergoing a slow motion sort of replay in the banking system. here in the U.S. now. Now, I don't know where it leads in the end. I mean, yeah, you could, everyone's saying Bitcoin this and that and whatever. I'm not like, yeah, I'm not that prescient to be able to figure that out. But I do have the financials on my radar all the time. I mean, listening to Janet Yellen last week talk about the regional banks, and she sort of said, well, I don't know. Maybe we'll just have 5 banks in the end. Citi, JP Morgan, and everyone else.
Right. So,
It's important.
so Mark, cutting to the chase, where's your head on bank stocks? Are they investable one way or the other?
Jeez, man, I don't know, because I think we're in a new rates paradigm. But again, I think that we're slowly being weaned off of the banks in one form or another. I mean, I saw a tweet today that JP Morgan was collecting 750 million bucks a day from the
Yeah.
Fed while they're
Right.
paying depositors nothing. I mean, people are going to wake up to that. So I look, George, I think you could trade them, of course, but I think it's a slow deterioration over time. There's other places to do better, I kind of think.
Got it.
One thing,
Yeah, and Mark,
just
oh,
and
go ahead.
I'll just jump in there. Quick question. We've had this regulatory problem with getting through any merger, and do you think that could open up, where the regulatory environment will open up and allow banks to merge a little easier? I mean, I think that unfortunately, I'm kind of like the same with you, like 1 + 1 = 1. But if two regional banks merge, and I've got this from a good friend of mine who is at Sandler, that they can do a lot of cost cutting to survive and get through difficult periods. Do you think that that's something that we will start to see? I'm skeptical of that, but just something to ask.
I mean, I kind of think that it sounds silly, but I think those who play ball get the easier passes in those situations. Like, just thinking back to long term, right? There were 2 banks that didn't participate in the bailout, right? Bear and Lehman. And we saw what happened the next crisis. So it's in everyone's interest in all of these places, these littler banks, these smaller banks, to play the game, right? Like in the FRC bailout, or whatever we're calling that, from last week or whatever, 30 billion came in from a handful of banks. It was like 4 major banks and 2 smaller, Morgan and Goldman, and then 5 other little ones. All those 10, it was like, if they didn't participate, the next time the crap hits the fan, they're done, right? So I feel like the littler guys could become like merger candidates, but they have to play by the rules, and make sure they know where they're buttering their bread to for the ease of that merger to be, so to speak.
Mark, thanks for the comments on banks. Stay there, because the next speaker, Future, knows a lot about banks. Future, if you can hear me, the floor is now yours. Future, can you hear me?
Yeah, hey, George. How are you, man? Nice to talk to you.
Go for it, man.
Thanks. Okay, so yeah, I'll actually try to keep it somewhat brief, because there's a lot of talent here, but I'm happy to kind of just keep the conversation going and answer questions and pose some too. I think the bottom line, George, is this from some previous conversations we've had. I tend to be pretty bullish in general, and I don't think I've heard anybody kind of estimate the amount of credit contraction that this banking issue is going to have. So I'm sort of very bearish, with 1 or 2 major caveats. And so, just to rewind a little bit, if I look technically, what's interesting is the Qs and TLT and gold, they all look pretty similar to me, and they all look pretty bullish. But I also think that, not all 3 can work. And so what I'm thinking is, and this actually kind of goes exactly to Bobby J's point, I think we either need to see a massive rally at the long end of the curve, or there's going to be some huge problems in the banks. So like the way, banking and bank balance sheets work is, you basically have economic issues and then accounting issues. And to me, the only piece that the market is focused on right now are accounting issues. And what I mean by that is if you put securities into your available for sale portfolio, those securities are marked to market and they hit your book value. So those are reflected, on your balance sheet quarterly. The other and much larger categories, which have an equal economic impact but are not being reflected, are the held to maturity portfolios and then the loan portfolios. And in the case of the loan portfolios, there's kind of three levels to accounting, 1 through 3. But the bottom line is that a lot of these loans, in some cases because they're jumbo mortgages or they're non-conforming, loans or commercial real estate loans, what have you, there are no liquid markets for these loans. And so the values reflected on the balance sheets and then the attendant book value associated with those loans could potentially be like grossly misstated. And so the way I'm looking at this from a macro standpoint, if you just kind of aggregate, and the Fed does this, or Fred, commercial banking sector has like 22 trillion worth of assets. About 17 trillion of the 22 are kind of securities. So we all know that we have some, duration risk / interest rate risk in these. A core product of the U.S. is like the 30-year mortgage. So in terms of its impact vis-a-vis duration, one of the most impacted securities. So point is, again, I'd love anybody to push back on these numbers, but take your 17 trillion, assume that half of those loans are impacted by duration risk, because you're going to get fixed interest loans, but you're also going to get, that's not me. You're going to get fixed interest rate loans, but you're also going to get floating rate loans, et cetera. So just assume half of your 17 trillion are impacted to the tune of 5%. So you're now talking about 8 trillion impacted by 5%. That's 400 billion. So the 400 billion does not sound like a lot, except for the fact that banks run, 7, 10, 15, 20 times leverage in terms of their equity to assets. And so my theory is the reason why, none of these assets can really change hands. And like you saw the SIVB merger occur, but it also came with like a $9 billion check on top of 90 billion in assets. But the reason why you're not seeing any of these assets change hands is because in a bank merger, you're required to mark the assets to market. And you can't in a lot of cases without getting negative book value. So flipping back to my macro point, I now take 400 billion of equity, like a potential hit to common equity that the banks have, again, against the 17 trillion, and I lever it, let's just say 10 times. That in terms of a credit impulse, that's a $4 trillion credit impulse, and that's 25% of GDP, roughly, a little bit less, 20%. But that's my thesis, and I think the problem is potentially so big that the only way we can solve this, it's not going to be these kind of one-off ring fencings of, deposits and kind of shoring up. It's like we have to find a way to get the long end of the curve down. The problem with cutting the short end of the curve is, ironically, it may send inflation expectations up, which will push long-term interest rates up, which will make the balance sheet holes larger. So then I start looking at Japan, and there's a reason why they have the long end pinned to 50 basis points. And, I think we might be heading there. So I'll pause there.
Hey, Future, let me throw something at you.
Okay.
So number one, on the banking situation, you mentioned held to maturity securities, and in the end, if the Fed is the ultimate backstop when the shit really hits the fan, isn't there sort of this invisible safety net that everyone sort of realizes is there? That sort of, those are the guys walking the tight ropes over the stadium, but they have that net down there. That's number one. Number two, on the long end in Japan, right? the BOJ owns like all the bonds now almost. And the Fed and here, I mean, everywhere, they can't really control that far end of the curve as much as we'd like to think and hope. So I wonder how you juxtapose that and your numbers. That's granular, too granular for me to have any, I don't know enough, but on the granularity there. But it seems like we're almost at a point where we're going towards Japan beyond our control almost. What do you think?
Yeah. I have lots of thoughts on that. So, the one thing I would say is like all these numbers are publicly available. So the micro numbers, if you just look, for three basic things, you look for the available for sale, and this is going to be on any bank's 10K. So you look at available for sale. You can look at the level 1, 2, and 3 marks on both the held to maturity and the loan assets. A lot of people don't capture those when they talk about banks. They're just talking about available for sale, but every single bank has basically schedule of a carrying amount versus, a mark to market amount, again, on loans and held to maturity. And you just go through and look, and the numbers, in terms of markdowns, I've yet to see any markups, but the markdowns are staggering. So it's a great question on the administration. I do have thoughts, which is you heard Powell say at the most recent Fed meeting, that the bankers had time to prepare. Certainly, if they were in Georgia during the last 12 months or however long, like they had advance notice of the fact that interest rates were going to go up. And so, yeah, the treasuries are pristine collateral, but again, it's not a credit quality issue as other people alluded to. This is a duration mismatch, and so the Fed's not going to cover you if you bought a 30-year treasury and it's now down 20%. And again, just think about how the leverage works. Like if I put up 10 billion, buy 100 billion of 30-year treasuries, and then the treasuries are down 20%, not only have I wiped through my 10 billion of equity, I'm in the whole 10 billion. And that's like illustrative, but look at the SIVB transaction and the numbers are actually pretty close to that. So and then you also like listen to what Joe Biden said. They don't want to, and they can't guarantee all deposits. So instead, what Biden is saying is he's basically like, the responsibility to kind of mop up the losses falls on the shoulders of, bank investors, managers, and pref, basically the bondholders. So that's where the losses are going to come in,
So,
and compress first.
so future, let me ask you. So, where does that leave you with respect to bank stocks? Uninvestable or too opaque? What is it? I mean, what is it? And what does that leave you thinking about the economy? I mean, at the risk of asking a leading question.
Yeah. Well, like I said, I mean, I'm not a macroeconomist, and what's interesting is like I've laid this math out. Again, like if you just go to the Fred website and type in total commercial assets, like anybody who looks at financial companies will take a view on the amount of common equity that is held against those commercial banking assets. And so, my math is out there. I think like it's pretty scary, George. I'm not a macroeconomist, but if I, think that the credit impulse in terms of a contraction could be even $1 trillion, that's like 5% GDP. It's a huge number. As far as bank stocks, I agree. They're typically pretty opaque, but if anything, that's kind of working against the banks, right? Because think about SIVB, who had their easy to value. Again, there's level 1, 2, 3. It's a little too wonky to probably get into in front of this many people, but treasuries are like a liquid, markable level 1 asset. There's a deep liquid market for them, and that's where they got into trouble. So now just think about the illiquid stuff, level 2 and level 3, what the marks could be there. And again, it's not like we don't have duration risk because one of the core products in this country, as I said, is a 30-year mortgage bond. So it's not just the treasuries which are taking marks. So hopefully that answered the question.
Yeah,
But
so for the average person in the room, so where does that leave you? It's like banks are just too hard. I mean, to invest in. I mean, Because I look at it and I kind of throw my hands up.
Yeah, they're tough. I mean, now I sort of go back to my like macro comment and just say, TLT looks strong, Qs look strong, and gold looks strong. But to me, like in a world where TLT and gold perform really strongly, like I don't think you're also going to get an attendant rally in the Qs. So the bottom line for me is, yeah, I'm not super bullish on the banking sector. Take that for what what it's worth, and they are opaque certainly, but like just keep in mind that if the long end of the curve keeps going up, this problem's going to get worse, and it doesn't just apply to a handful of regional banks. You can look, up and down the chain, so to speak. And yeah, so like I like TLT, and I'm pretty bearish on the economy. And yeah, as far as bank stocks, I just don't want to get into individual names.
Yeah, so you like TLT? Do you also like gold?
I do, and I'm the opposite of whatever gold bug is, but I do like it.
Hey,
right,
one thing, Future, that really good points. Yeah, and you could get wonky in here, and that's that would be. I'd love to chat with you further. The one thing the way I'm looking at banks right now, in the financials, I think there's there's been an earthquake that's happened in the whole sector. There's been capital flight, and I really want to see where things sort of wash out on earnings and the earnings calls, because I think it's going to be very revealing once companies are able to have a frank discussion as far as where their businesses are and vulnerabilities, because I think I think there's aftershocks that are going to happen, and especially we didn't even get into really deep into commercial real estate and some of the risks there for a lot of the banks, but that's for another time.
Yeah,
Hey, George. I'm sorry.
I guess just to cap that off, and I'll go on mute. But yeah, thanks, Tom, or reach out anytime. But I was going to say, contrast that to like J.P. Morgan. There is another side to this story, which is obviously like capital has flowed one direction. It's flowed to the money center banks, and that's going to be low cost funding for those guys. And so you'll probably some of it will get made up there, but I would just encourage anybody, like, look at the assets, look at the marks. Does not just apply to the regional banking sector. So, and the one final thing on JP Morgan, they'll show you like the average rate that they will earn on originated loans in any given quarter. And so like their Q4 looks pretty good. Like they're averaging what you'd expect, around like 5.5%. So that looks really, really good. But then you compare that to the interest rates that, some of the relationship driven sort of communities are earning over the last quarter, and they're much, much lower, which is not good given where funding costs are right now.
Bobby J?
Yeah, as a whole, banks have not been investable for long-term as a long-term holding, because we all know that the sector used to represent about 22, 23% of the total S&P index, and that has shrunk down to about 8% over the last 25 years or so. So, we're going to have continued shrinkage. We're going to have more deposit outflows, but this industry has to right size. Now, the good news is there's about 20,000 branches that need to close, because you ask anybody who's under the age of 40, when was the last time they went to a branch, and they'll say never. And every branch that closes is about 700,000 in savings to the system. And the other thing you should know, which is a startling number, is that out of the 4,400 banks out there, about 3,000 have 5 branches or less. So this is really, like I said before, getting lopsided. You'll have trading rallies. Anytime the Fed eases, you have bank stocks rally, but you better be a fair weather friend. And in terms of mergers, 2 dead batteries aren't going to start a car. So
thanks, Bobby. Appreciate it. Let's keep moving here, because we've been going this for an hour and a half. Time flies when you're having fun. Let's go to Dave Nikoski. Dave, if you keep it kind of tight, because I want to try to wrap this room up by 6 if we can. Dave, floor is yours.
Absolutely. I just want to say Thank you, George. I think we did a call on February 22nd, and I, was all over the banks at that time, long before anyone was talking about them. My thoughts on the banks, and I haven't heard anyone bring it up, but what about geographical locations of banks? It seems to be that you have, obviously, the VC intensive areas of California, high rapid rise in asset prices in terms of real estate, um, derivative type lending. You had MCB today in New York having somewhat the same issues. That was a bank that, if you go Google it, had done banking with Coinbase as well. It looks like they halted their, cryptocurrency relationship with Coinbase. I think it was January 9th of 2023. So I don't know if the bears are jumping all over that, but that was down extremely hard today. I'm just wondering if anyone out there that has the banking expertise that, if you're in a small community bank that, there's 25 branches, 50 branches, they probably don't do the sophisticated type of investment that a lot of the bigger banks will do. Probably Midwest, Texas, Arizona, Florida, if, they've seen population growth, probably deposit growth too, along with that population flow. Just throwing things out there outside the box, things to think about. Anyone have thoughts on that?
On MCB, on MCB.
No,
Yeah.
about the thought process of geographical regions for banks, the types of loan quality that they do. When you get into a small town, you don't have, huge, 50-story office buildings that commercial real estate is going to buy.
Yeah, Dave. I think Josh and/or Future might have something on that.
Yeah. Okay.
Future, Josh, either of you?
Yeah, I'm not a financials guy per se, but I think their crypto exposure was quite minimal relative to Signature Bank and Silvergate. But yeah, anything remotely related to crypto is radioactive. So, but I don't have anything to add on the other point. So I'll let Future take it away.
Future?
Oh, yeah, thanks. So just real quickly, I do think, regions and asset mix are important. But what you've actually seen is the regional banks like take up the slack from the money center banks in terms of loaning to CRE. So they're way out punching their weight in terms of exposure to that category. So like I guess I was just going to say like the regional banks do serve a function, and the fact that credit extension is a local exercise. You have to understand the real estate asset, the small business, whatever it is. But then again, like my personal theory is that I think the money center banks had a more macro view / concerns around commercial real estate and interest rate risk and all the things we're playing out now. And again, like the regional banks took that burden onto their balance sheet and were the ones who extended a lot of this credit. So like there are names, in the Midwest. If you just Google like the skyscraper bank, I think it is, there are names in the Midwest that are financing like skyscrapers out of their way outside of their backyard. So just like another interesting point, I think the regional analysis makes sense, but you actually have to go and look at like where are these regional banks extending credit, and like why didn't the money center banks, why weren't they the ones to do it?
Got it. Daniel, floor is yours. Daniel?
Thank you, George. How are you today?
Good. What's up? What's your question, man?
No, not really a question. Just piggybacking off of the topic here with the geographic location of banks, whether or not it's an issue. I'm in New York, and I'm not by far an expert on this topic, except I can just share some things that I'm hearing is in the city, for instance, in Manhattan, you have a large amount of vacancies in office buildings in the city and in Manhattan, and these regional banks, including Signature Bank that I was short, were had a large commercial real estate part of their business. So I think geographic location is important to look at in New York and California. Actually, in a space I had earlier with David, who's on stage, we were discussing this very topic. So it's something that I'm looking at. I'm actually personally short, Metropolitan Bank. I think they have some issues, but yeah, I'm not up here to really talk too much. I wanted to listen. Thank you for the mic, and I enjoyed the space.
Thanks very much for that. Maybe we should talk offline. Okay, who's on stage that hasn't spoken yet? Guy Sarandulo, my good friend. Floor is yours.
Hey, George. Hi. Hey, Tommy. George, just wanted to share a couple of things. So this afternoon I ran it's a multi-factor model I put together a number of years back when I was working at Wellington. But I ran the screen of the S&P 1500. And I do that pretty consistently to get a sense of a bottom-up approach of how many stocks are in an uptrend on an absolute and relative basis, and measuring the momentum of those two trends, absolute and relative. And so these are slower moving, and it just tries to give you a sense of the participation of stocks advancing, declining, etc. I had to take a double take because of the numbers that popped up. So as of this afternoon, there's 23% of the stocks of the S&P 1500 with a favorable score. Again, this is showing on a weekly basis the momentum of absolute and relative in the absolute and relative trends of both in the trending environment. Momentum of those trends are favorable. So only 23%. But what was really shocking is that 70% of those stocks have a poor score. The last time we had a score in the sevens, the 70 handle, was at the October low at 75% and June low at 78%. So if you think of it, June 78, October 75, and now 70, and the S&P is well above those lows. What this is telling me is that it's a narrowing environment of stocks that are propping the index up. And again, these are weekly timeframes of slower moving. So to me, it smells like we're on thinner air as the market has advanced. So I'm going to do a further breakdown tomorrow in terms of participation within sectors, but I thought that was like an incredible stat. I threw the chart up on my Twitter space, for people to look at. And anyway, I just thought that might be of interest.
That's terrific, guys. So, guys, you're saying only 23% of the stocks have favorable both absolute and relative scores. Is that what I understood?
Exactly. So there could be some scores that are favorable, but they're deteriorating, but they have to go below a certain threshold to go neutral and then negative. But as of now, it's only 23%. Yes.
Okay, I got it. And so that's wow.
But what scared me is just that it's 70% are negative. So the last time we're that low is when the market was down at the trough. So it just less participation on this move up over the last number of months.
Right.
So
wow.
Anyway, just to be careful.
That's great. I don't know if Dave Nikoski or Tommy Thornton have any want to weigh in on that at all. These technicians.
Yeah, I posted quite a few things to my timeline over the last several weeks about just a complete narrowing of breadth. Whether you took the triple Qs, I think 46% of the triple Qs are above their 50-day, just to give you an idea. So and that's like that in just about every sector. You're not getting participation by the retail. XRT is very weak. It's near its October lows. I've never seen a bull market start with, just tech moving and, Staples, the XLP is breaking the downtrend. If you look at relative strength, even on the XLP, you have ascending rallies and reactions taking place, and that bottomed, early February, I believe it was. February 8th, I believe, is the time that bottomed. So, I've never seen Staples lead into a bull market, but the XLP has been leading the S&P since February 8th, to give you an idea. So.
Wow, that's not.
Hey, George, let me just chime in real quick to sort of push, add a little bit here. So obviously 2022, we saw the tech space just get destroyed. and everyone sold tax loss selling, maybe one of the biggest tax loss selling end of the years ever. And then on like January 4th or 5th or 6th, there was that massive factor reversion, right? And tech and Apple and Amazon went crazy. Then I looked at February 2nd, which was ironically enough Groundhog Day. That was the day Amazon put in its big earnings. It gapped up, massive volume. The next day it gapped down. That's like what we call island reversal or abandoned baby, whatever your technical parlance is. Since then, Amazon's still down about 12%. So to me, that's the sort of line in the sand that will tell me if the bull market's coming back, is if that island gets taken. Now, interestingly, in March, right, we had the banking crisis, whatever we're calling it. And in the last handful of days, we actually saw people selling bonds, which are normally safe, and piling into tech, which I think Guy and David just pointed out. That's the narrowing of the rally. 5 or 6 stocks leading the whole, holding up the whole logjam, so to speak. So it'll be interesting. Obviously, tomorrow's the last day of the quarter, but we're heading into earnings season in April. It will be very interesting. All the people who just piled right back into tech, memories of goldfish, as to where we're going. And then one last point to futures, what he was saying about TLT and the yields and the Qs. We have to remember 00 to 02, the Fed cut from 6 to 2, and the SPOOs got cut in half because that was like a panicky kind of like yield. Yields went down because of the panic, if you will. So that's the scenario that Future was talking about. I'm trying to tie together a little bit. The TLT looking good, and yet he's not sure if TLT and tech could both rally. I think there's something to that. So we're heading into, after this quarter ends, it seems to like there could be a normalization. And I think this past quarter was a little abnormal. And Guy and David just pointed that out. So I agree that we should be concerned, just a little bit cautious heading into Q2. That's what I got.
Hey George, if I may, real
Yep.
quick before we end, I
Yep.
was getting a DM as we were talking about Nvidia earlier. I have the same time frame short position as
Sure.
not Tiger, and someone was messaging me saying that, and maybe this is not significant, I'm not sure, but after hours in Nvidia, there was a couple sells of over 390,000 shares, totaling around 273 million, and then about 75 million shortly after that. This is all like within the past hour and a half or so. So it didn't seem to affect the stock price too much in after hours, but maybe we see that come into effect maybe tomorrow or next week. But yeah, I agree with Josh on that on Nvidia.
Thanks for that.
Thank you.
Let's take a couple more, and then we're going to close the room. Let's go to Jeffrey. Jeffrey, the floor is yours.
Hello, can you hear me? Hey, can you hear me?
Yeah, we got you, Jeffrey.
Hey, I was just wanted to chime in if anybody had questions on the CRE at banks. I've been a bank analyst for about almost 30 years now, unfortunately, some cases. But what people are earlier, there was a discussion around CRE on banks and community banks versus money centers and whatnot. And I think if people are going to do the work and dig in, it's all on bank filings. You can get it quarterly. A lot of banks are very good about disclosure in their investor presentations as well if they want to dig in. But I would just caution that don't just broad brush every bank's CRE portfolio as being office, because also in there you have warehouse, industrial, multifamily, lots of other types of loan categories that would be very interesting to look at kind of on a piece by piece basis instead of just blanket saying all CRE is bad. You have multifamily, which is a 55% type of loan to value ratio. You have lots of different types of office. So your suburban dentist office your dentist is doing well, and they're going to keep paying their mortgage. If you have an urban CRE office portfolio like Signature did, that's clearly a problem. And that's why they're not here anymore. But most banks don't lend to office towers. Most small community banks are too small to even make that kind of loan.
So you really got to get in the weeds and look at them on a bank basis. Is that what you're saying?
That's what I'm saying. Yeah, you just have to you have to pull apart their disclosures and look at it kind of on a one by one bank basis, and just saying broad brush all CRE is going to be weak is just not the right way to look at it.
So when you look at the sector and the way you look at it, do you see a lot of mispricings, i.e. some areas where they've thrown the baby out with the bathwater, and yet other names where they really haven't taken an axe to the stock price the way that they should?
Definitely. Yeah, I think that they've definitely thrown the baby out with the bathwater in some of the community banks and smaller regional banks um, that just don't have this type of loan exposure. They can't. If you just think about the size of the bank and its balance sheet relative to the size of what an office tower loan would be, for example, they don't have the capacity to make that loan in the first place. They're lending to your two-story suburban dental or medical office, which is a very sticky type of loan versus now the ones Signature in Silicon Valley 100% deserve to not be here anymore. They had their own funding issues and they mismanaged their balance sheets. But if you start digging, you start getting into the 50th largest bank in the country or the 100th largest bank in the country, there's about 300 or so that are publicly traded. Very different outlooks. People are not fleeing deposit bases of your community banks or your regional banks that are out in the Midwest or out in rural areas. If you go out and see, if you're going in, if you're a bank in Montana or a bank in Idaho or a bank in rural Oregon, those banks are not seeing deposit outflows. And I had a conversation with the head of investment banking today at a large bank specialist firm. And he said that he expects when banks report in about a month that you're going to see deposits down anywhere from at most 0 to 1% at most community banks. They're not seeing the deposit outflows that the Silicon Valleys and First Republics and Signatures had.
Right.
First Republic is an issue, but smaller banks aren't seeing that.
Right. That's terrific, Jeffrey. Future, do you want to weigh in?
Yeah, no, that's great stuff, and definitely an important distinction to make that you can't group all these in. I guess I just wanted to go back a little bit to the macro and then maybe ask you a question, Jeff. Thanks for expanding on some of these things. So to me, the primary function of a bank is to borrow short and lend long. And so the yield curve has been inverted for quite some time. And, it's inverted actually a little bit more in the early 80s. But if you look at just a percentage of the base rate, we are far more inverted now than probably any of these bankers have ever experienced in their lives. And so my kind of point, and really maybe it's just a question back to you, is you look at the quantum of lending that was done in 2020, 2021, and part of 2022 in the ZERP environment. And the balance sheets went vertical. And not only did the balance sheets go vertical, but they went vertical at a time when nobody really wants those loans at the par value they were underwritten, not because they did a bad job on underwriting the asset, not because rents are moving up or down, but just because simply the interest rate is too low. And so my thing with all these guys, doesn't matter if you're a great underwriter, have good assets or bad, just because of the way that the yield curve has moved and the way interest rates have moved, those securities, those assets are not liquid. And now you couple that with, that's an interesting stat about people not moving their deposits around or 0 to 1. But you couple that with, an environment where depositors are going to increasingly demand at least something on their deposits. Maybe it's not 5% or even 3 or 4, but a lot of these loans are underwritten at, 1, 2, 3%. So I guess my question is how do you square, how does a bank get liquidity given where these marks are?
I think there's a lot wrapped into that question, most of which I agree with. The premise of the question, which is that rates were really low, almost too low for banks to make economical loans. For the most part, if you were looking at fixed rate, kind of long-term, say a long-term fixed rate loan on a multifamily property or just a general commercial real estate property. And a lot of banks, especially the smaller banks, stepped back from doing that and didn't want to make those loans. So those loans were not made by your average community bank. For the most part, they were made by life insurance companies or pension funds or what some people refer to as shadow banking. I don't really like the term, but credit funds that have raised a lot of capital. Kind of think of your Blackstone credit fund that's making larger loans. So they did extend those loans. Life insurance companies have made a lot of these fixed rate, longer term CRE loans. So that's an issue. I think the issue, broadly speaking, is the one that when the system got flooded, the system was kind of starved for deposits up until COVID, and then suddenly got flooded with deposits with all the government spending. So they had to find a place to put it. The smarter ones put it in short-term securities, like a JP Morgan. You can look up Jamie Dimon's comments a year ago versus Silicon Valley's comments a year ago, what they were doing with the money. And Dimon was saying he was staying short, and Silicon Valley was saying they were going long. So again, it's kind of a go bank by bank and see what they did. But as a systemic issue with the marks and where rates have gone, you do have issues with the held to maturity books. That's why they put in the latest facility to let banks access liquidity to continue to fund them if needed, and then wait it out. So the best thing that could happen for these banks would be, as I think it was discussed here earlier, is for rates to go back down. You're going to see already with the move that we've had in rates this quarter that a lot of these marks that were on the balance sheets at 12/31 are going to look a lot better at 3/31. Just bond math, right? Rates are lower, so the value of the securities has gone higher.
Right.
I could talk about it a lot more, but I know you want to keep this short.
Yeah. Anyone else? I think we're gonna, unless anyone else has something they want to say. Anyone else on the panel? Any other bank comments? Otherwise, this has been a fantastic room. And Tommy, I want to thank you as always. Did a superb job kicking the whole thing off. It's been a great room. We'll do another one next week. And everyone be well. Have a terrific weekend. Good night, everyone.